Welcome back to Liberty and Finance. We are really live tonight. Sorry, we're a couple minutes late, but we are here live, and we have Andy Schectman, the CEO of Miles Franklin Precious Metals. Today is Wednesday, June 25th, 2025. Andy, thank you for coming back on Liberty and Finance for this live weekly market update.
Always a pleasure, Don. Again, thank you for having me, brother.
And we've got quite a boatload of people in the audience here in the live chat on YouTube. Folks, if you want to participate in this live stream and ask questions directly in real time of either myself, Dunnigan Kaiser, the host of Liberty and Finance, or Andy Schectman, the CEO of Miles Franklin Precious Metals, make sure you're in the YouTube live chat. You need to go to youtube.com/Liberty and Finance. Make sure that you are subscribed to Liberty and Finance. That way you get into the live chat and then type your questions in the live chat. We'll try to get as many as we can in front of Andy tonight. So Andy, one of the things we wanted to talk about that we put out there in the teaser was with geopolitical strife coming and going on a daily basis. Do we have any further insights into the direction that we expect precious metals supply, demand, and prices to be headed in the near term? Because that's on the top of mind for everyone who's watching all these things unfold in real time. And I guess the other backdrop is the dollar continuing to drop, the Dixie against all the other currencies. And that figures into this whole picture you've been painting for us for quite some time now of the weakening, the global pivot, frankly, away from the US dollar for a number of reasons. And I'll give you the floor, and I'll check the list for more viewers' questions as you respond to this first one.
Well, I think the conventional wisdom is that gold and silver drop due to easing of the Israeli-Iran tensions. The signing of the temporary or hopefully the long-lasting ceasefire, but that's not what it was. I mean, you had options expiration. You have the end of the quarter, which options expiration was today, mind you, and I think it's interesting that they really had a hard time keeping it at or near $36 an ounce. And if you look at the amount of contracts that they had trying to keep it below that level, it's really quite incredible. There were 76,617 short contracts to keep the price down. It's an all-time record. And here it is. It's right back up. The physical demand at that level is extraordinary. But to see gold down $100 since June 12th and silver a buck lower, that's not a reaction to geopolitical events or a cooling of the narrative. This isn't a natural correction. It's a managed decline, and it started Sunday night, and it went all the way down to today. But not only do we have the end of quarter and the options expiration, you have the July contract, which will go off the board, I believe, on Monday, the first day of delivery requests. And so we've been seeing tremendous deliveries come out of COMEX. I would expect to see that continue. Look, the prices were reacting long before any conflict had arisen in the Middle East, certainly the one that we're focusing on. But since President Trump was elected, you've had almost 820 tons of gold stand for delivery done again, and somewhere in the neighborhood of 9,000 tons of silver stand for delivery. The trend is not stopping, quite frankly, and you can see the amount of effort that the banks are using to keep it down. I mean, it's extraordinary when you figure each one of these contracts on silver are 5,000 ounces, and they're trading 76,617 contracts short to keep the price down. That reeks of desperation, and it reeks of stupidity, if you ask me, because you have a good portion of the world who is using that effort, that manipulative effort, to stand for delivery and rewrite the narrative. You could say the same thing is happening with platinum at the same time. So I think that how well gold and silver have held up through all of this is noteworthy, to say the least. So yeah, I'm actually quite surprised and quite optimistic that this correction is behind us, and that the amount of effort needed to hold it down is something that has to have the banks on their heels and very concerned.
You mentioned a couple of times just now the firepower that it takes in terms of huge numbers of contracts of futures to hold back the price of gold or silver at these levels. We have a question from A Platts 55 who says, when gold rises very quickly I understand it's not influenced from the central bank. So then who has the greatest power to move the markets so fast?
Well, I mean, it is, on one hand, it is the central banks. It's what it is to me more than, I mean, that's a good question. But what it is, it's that the gold and silver disappearing from the exchanges, that's the physical liquidity upon which this entire house of cards is based. And if you're pulling the liquidity out because it's standing for delivery, that's a problem. What you see in many cases is what's called a short squeeze, where the traders do not have the ounces of gold that standing behind the contracts that they have. And so they have to rush to get it in order to cover. That represents a short squeeze. So it is the buying of the central banks. It is the buying of the sovereign wealth funds. It is the buying of the biggest money in the world, the sophisticated money in the world, who is able to accumulate and stand for delivery, that is affecting the price at that level. And yes, it is exacerbated by these moments of panic covering in an environment where we continue to see delivery requests. And that's something that I think people need to really understand, that this is something that never, ever happened before. David Jensen does an amazing job on Substack of explaining this. He talks about, look, the LBMA is trading 200 million ounces of gold per day and 3.43 billion ounces of silver with a B per day. That's almost 4 times global mine supply per day, annual global mine supply per day, standing behind somewhere in the neighborhood of, I don't know, under 200 million ounces. That is the float. I think it's much less than that right now. So you're talking 12 plus times the float. What you're witnessing right now is a desperate effort by the West, who has always been able to easily manipulate the price of gold and silver through levered contracts, because no one ever challenged them by standing for delivery. And that's really the difference. And these deliveries continue to happen across the globe. So yeah, I think should be looked at as a very optimistic and hopeful development, where they have to expend that kind of effort to hold the price down, and yet it really didn't go down very much, didn't dip below 36, and if it did for a very, very short period of time, and here we are right back above it again. I wouldn't want to be as stupid and irresponsible as these banks are, having that kind of a short position in an environment where much of the world is challenging it through delivery. So yeah, it's to his question, I think a lot of it is short covering, but it's short covering because these players, whether it be central banks or sovereign wealth funds, are standing for delivery. That's what's different.
You've been talking so far about the physical off-taking of metals from the exchanges that then has to be satisfied by fulfilling contracts for delivery, which then forces sometimes short squeeze and has to get the price moving. There's also policy changes that are happening. We have a question here from Fazdal. Is Andy expecting any gold movement, any gold price movement, or physical gold movement, I guess, from the upcoming Basel III rollout that's expected July 1st?
I don't know that you'll see it immediately. I think you're beginning to see it. I think you're beginning to see, maybe this is part of the reason we're seeing so much in the way of deliveries to back these naked contracts, to have the physical. I think it just will be much harder for banks to continue to play this game where they're using unallocated paper derivatives, which will dramatically affect the balance sheet. And so, yeah, I think this is an environment where we could expect to see much higher prices after the Basel III, maybe not immediately, but what it ought to do is make it much more difficult for these players to continue to suppress the price with unallocated paper, especially if they're standing for delivery, and especially if it starts to really negatively affect their balance sheet. This will become a game, I think, where that kind of position is considered foolhardy. So yes, ultimately in the long run, I think it's one of these deals where we can't expect it to happen just like that the moment the switch is flipped, but I think it is a trend that we are seeing where these banks already, it appears as though they're realizing this in gold. We haven't seen them capitulate in silver yet, but I think that's coming. And quite frankly, to have these unallocated naked positions against the backdrop of global demand and global offtake is as stupid as a mud wall in a rainstorm. And I think it will have a dramatic effect, maybe not all at once, Maybe not at first, but over time, absolutely it will.
We have a question here on a slightly different tactic. Schwarzenegger says, ask Andy for an update on the BRICS in July or the Japanese yen carry trade.
Well, as far as the BRICS are concerned, a lot of it will rear its head over the next several weeks. But as I've mentioned to you before, to me, the biggest development is Sergei Lavrov coming out and saying that the bridge network, their cross-border settlement payment system, which is mBridge, will be open to non-BRICS members. And that is something that has gotten no attention. To my knowledge, I'm the only one screaming about it, but it's massive. Because what you really have are many, many, many countries and alliances that are indirectly aligned with the BRICS nations, in particular China. Whether you're talking the Belt Road, the Shanghai Cooperation Organization, or the Eurasian Economic Union, those entities alone added onto the BRICS equates to roughly 90% of human population, the majority of global GDP, the majority of global commodity production, refining, the majority of the manufacturing capacity on the globe. You have Vietnam, who is just fully applied. Of course, China and Vietnam being two of the main manufacturing hubs in the world. You have Indonesia, who has just fully been admitted in and massive stash of nickel and rare earth. You have Mexico, who is now saying that they want to be one of the 45 countries who want to attend the BRICS meetings. You are seeing a growing alliance. And so, yes, I think the biggest thing to take away from it is the admission by Lavrov that these countries will be able to use the BRICS settlement system, which is trading central bank digital currencies across the bridge technology, which is mBridge, without the interference of SWIFT, settling in gold. We are seeing more and more rumblings coming out of the Shanghai Metals Exchange to open up exchanges across the network, across Africa and Asia and South America, to where that they will be able to internationalize gold deliveries from the Shanghai Exchange. The idea being we trade our local currencies over the mBridge, settle any imbalances in gold. Now, the pushback to many of these statements would have been the BRICS alliance is not big enough. Okay, fine. You add in all of these entities which are BRICS aligned. The Belt Road alone is 75% of human population, 50% of global GDP. You add in the Shanghai Cooperation Organization and the Eurasian Economic Union to this, on top of the Belt Road to the BRICS, and you are talking a massive, massive swath of human population, of global production, of commodities, of global manufacturing, of military might. And I think it's something that would be a huge mistake to underestimate, with the stated goal coming out of Brazil being to find a new settlement system that bypasses the dominance of the dollar and the SWIFT system. So to me, that is what I am looking to see, and that's a big one, a really, really big one. And you'll note that they're very keen in saying that this technology, this BRICS technology, the bridge, mBridge technology, is not compatible at dollars, pounds, and euro. So you're pigeonholing the West, and you are opening this up to the majority of the nations around the globe that are underdeveloped, that are resource rich, and that are looking to find a way not only to improve their standard of living, but to do so in an environment that perhaps is one that is more about cooperation rather than coercion, and converting to a dollar that has been very strong has been very difficult for these nations. As far as the Japanese carry trade is concerned, yeah, I mean, I'm surprised we haven't seen more fallout from it yet, but this is a situation that is unwinding. Of course, the whole premise of the carry trade was that institutions or countries or people could invest, buy or borrow in Japanese yen at next to nothing, at zero rates, and then convert to dollars and buy dollar-based assets, whether it be cryptocurrencies, whether it be Nvidia stock or Apple, whether it be treasuries. And that's unwinding as the yen goes higher and the rates go higher. That remains to be seen how that all plays out. And even the wild card, do they actually entertain joining BRICS, as people like Jim Willey have thought perhaps is in the cards? So there's a lot of fluidity. Then again, the difference between this administration and last is the last administration, their actions were too stupid to be stupid. And therefore, it was obvious what they were trying to do. This administration, Their actions are more subtle and maybe even a little bit more confrontational, but all leading to the same thing, and that is an increase in de-dollarization, an increase in unification by these countries, safety in numbers. And I think when you look at what's happened with Iran, and some people might think, well, maybe it's a little bit more than meets the eye. Maybe this is a shot across the bow with the BRICS, as in fact they are full BRICS members and are full Shanghai Cooperation Organization members. This will not be something easy, and I think these nations understand. You look at India, you look at Saudi Arabia, who seem to be straddling a little bit both sides. That's understandable. Until everything is set and everything is unified, this will be a slow-moving, yet developing event. And I think people need to not focus too much on the immediacy of something like the BRICS meeting, but look at the pieces that continue to be put together. And as far as I'm concerned, this has not stopped. In fact, this is the biggest piece of BRICS bullish news that I've heard in the 4 years I've been covering it, and that is that they have the ability to offer this network to non-BRICS nations, with the exception of the euro, the pound, and the dollar. I think that is a massive shot back across the Western bow, and something I'm looking forward to see unfold over the next few weeks as that meeting starts here in the first week of July.
Just an observation that it wasn't that many years ago that Japan was one of those countries that could be relied on to rescue a U.S. bond auction gone sour overnight. If there started to be, the interest rates spiking and then nobody buying the bond or whatever, miraculously in the morning it would be all okay. And they say, yeah, it was either what was it, Ireland or Grand Cayman or who else besides Japan? But Japan was more than once
Well, the
was
United Kingdom
rescued.
has surpassed China to number two. And as Vince Lancia said, it's like two drunk guys holding each other up. You have, one broke nation buying the debt of another broke nation. And it's silly when you think that. And if you really do believe that a country as small as the Cayman Islands is using over 15% of their entire national budget to buy our treasuries, I have a bridge to sell you. And that's why, again, I bring up Jim Willey again, and his take is that the Federal Reserve is paying under the table to these countries to buy our treasuries. Now, could it be? I mean, it's certainly plausible, because who in their right mind would buy a treasury from the United States of any duration right now at 4% interest rate or so on a 10-year treasury is just silly in an environment where inflation is absolutely kneecapping that. And this is why you get the lies coming out of the CPI or out of the Bureau of Labor Statistics, namely the CPI, which tell us that inflation is under control, yet it's a different number than my grocery bill is telling me, than the restaurant bill is telling me, than the tuition bill is telling me, than the insurance bill is telling me. But I thought that inflation was under control. Well, no, I think it's a stated goal of the Bureau of Labor Statistics to not be honest with us for reasons such as this. And you can see President Trump certainly would like to see rates go lower, because we have somewhere in the neighborhood of, I don't know, $9 trillion in debt that needs to be refinanced here over the next several months at rates that make it that much tougher. So, look, I just think that this is something that will have great fluidity, and I would certainly not underestimate the significance of what Sergei Lavrov has said by opening up this payment system to countries that are not BRICS nations, because they have an awful lot of nations that are aligned ideologically and other ways with China, with the BRICS. And this is a way to, I think, really, really accelerate the development of alternative payment systems to the dollar.
We have a very intriguing question here. We may not know the answer, but I think it's worth talking about. And this was pointed out by Frank Badalato, who says, Kitco says, and I verified this just before asking the question here, as of June 2025 now, Kitco will no longer provide London fixed prices or historical London fixed data due to updated redistribution policies implemented by the London Bullion Market Association, LBMA. This change affects users who rely on Kitco for access to this specific type of precious metals pricing information. It's either London fixed prices or historical London fixed data. There certainly has been a lot of dust kicked up around the last 3 or 4 months about metals movements from London to New York, and kind of some let's just say tap dancing by the LBMA as far as why there were huge delays. You've spoken with us about it several times, but this one was a new one for me. I don't know if you've heard that particular point before, that Kitco is basically no longer going to be sharing the London fixed prices or London fixed data, and they say due to updated redistribution policies implemented by the London Bullion Market Association.
No, I haven't heard that. It doesn't surprise me, to be honest with you. It's kind of like when I started in this industry 35 years ago, the Fed used to publish, or the Bureau of Labor Statistics and the Fed used to publish something called M3, which was the broadest measure of the money supply. And under Bernanke, he got rid of it, saying it was an archaic number that no longer needed to be published. It wasn't significant. But what that was the ability to measure the amount of money that was entering the system. And of course, for convenience reasons, they cite it was too costly, no one used it anymore. They got rid of it. Well, it's the same thing here. I remember, I don't know, 7, 8, 9, 10 years ago, I did a presentation at the time it was the Vancouver Agora Conference, which has subsequently been changed to the Rule Conference.
Mm-hmm.
And there's a man named Dmitry Speck. And Dmitry Speck is a brilliant, brilliant man. And Dmitry took a chart of 10 years worth of market movement and condensed it into one chart. And what he would show would be the AM and the PM fix, and all of that movement over 10 years worth of trading into one chart. And what you saw when you looked at that chart was truly breathtaking. And I could probably dig that up maybe for the next time we talk. And that is simply that it would go like this: AM fix, bang, and creep back up, PM fix, bang, and PM fix as you're heading into New York. These two waterfall events, and then as you hit New York, it would slowly rise in through Asia, hit the UK again, and bang, and bang. And that's not how markets work. And I think it's been the stated, I think, mission of those bankers to suppress the price using the AM and the PM fix, and largely as it heads into New York with one arm tied behind its back. So that doesn't surprise me at all. And again, it speaks to more desperation. When you have a market that's trading 200 million ounces of gold per day with like 10 times less gold behind it, and as much as over 3 billion ounces per day, almost 4 times global mine supply annual per day, with a float 12 times less than it's there, you want to do all you can to blur. And it's the same reason that they lie to us about inflation and full employment. These are the metrics that the Federal Reserve is supposed to do policy on. And if you're trying to base your policy and your indebtedness off of low interest rates and stable employment, you're going to lie about it. Well, the same thing is true here. And again, it's just the realization, the sad realization that the people playing the markets, I guess I'll just simply go to what Chris Powell, and we all owe Chris Powell and Bill Murphy a debt of gratitude. I don't say it enough. Those two gentlemen who started GATA, the Gold Antitrust Action Committee, and Chris is famous for saying there are no free markets anymore, just manipulations. Well, the same is true with information. And we see that coming out of the Bureau of Labor Statistics. Now we see it coming out of the Bank of England. It's just more of the same. So I think this is where I've come up with the statement: you have to trust your gut. You can see it, you can feel it, doesn't matter what the numbers say. They're caught and they're afraid. And that's why the Bank of England, or the European Union, the European Central Bank, has come out and said that the gold demand, the gold market, is actually a threat to the entire global financial system. Well, that's right, it is, because you have massive amount of contracts that are standing behind just a little bit of gold, or the other way around, a little bit of gold and silver standing behind a massive number of contracts that are now standing for delivery. This is what he's talking about. It's another way of saying, yeah, we got caught with our hand in the cookie jar. And so they're going to do all they can to blur that information from anyone who's trying to figure out a strategy. Doesn't surprise me one bit.
The correlation to that is the quote from George Orwell: in a time of universal deceit, telling the truth is a revolutionary act. That's why it's a threat to the system, because it's telling the truth. And if the system is based on deceit, then anybody who's a truth teller is a threat to the deceit of the false system.
It's true. It's very true.
And just interviewed Bill Holter earlier today. That's going to come out later this week. He talked about anticipate greater volatility. What you just described about 3 minutes ago was incredible volume, low float, and even lower physical to back it up in as far as what can the reserve you have in liquidity to cover that in the face of those huge volumes are necessary to try to suppress the price. Can you talk to us at all about if whether you believe that there's greater volatility likely ahead?
Yeah, I think volatility is a tool of the cartel. Volatility within a range is what they've been using forever. They use things like volatility. They use things like counterintuitiveness as an example. Everyone would have thought that the stock market should have got its rear end kicked and gold and silver and Bitcoin and oil should have gone straight to the moon during the acceleration of the bombing between Iran and Israel. And of course, it did the opposite. But going back to the Gulf War, when I don't know how many years ago the original Gulf War was, I don't know, it was probably right at the very beginning of my career. It had to have been close to 30 years ago, if not longer. The exact same thing happened. They delinked the rationale that people use to run to these assets. Whenever we would expect it to move in one direction, typically it goes the other. And this is part of the ploy that they use. But volatility is another. They use volatility within a range to keep people on the sidelines and to delink the rationale that we've all grown up into believing that gold and silver are tools or safe haven tools to protect our wealth and our finances in periods of uncertainty and chaos. Well, that's Cartel 101. But yeah, I would expect, and Jeff Clark did a great piece many years ago where he talked about, and he went back and looked at all sorts of markets throughout all sorts of history, and the common theme was that as markets reach a blow-off stage, as they really accelerate, you see much greater volatility. And the easy way of saying that, then again, is that the bull wants to take as few people along for the ride as possible. If it were that easy, well, everyone would be wealthy, and it's not that easy. But this is even bigger. This is a changing of the guards. This is a reorganization of the global monetary system, and there are players that don't want this to happen and certainly don't want to make it easy. So yes, I would expect greater volatility, but within a range. And that's kind of what we've seen. Great volatility in gold and silver, but within a range, and lately higher lows and higher highs. So all very bullish to me and all to be expected, and no one should expect this to be easy. We're talking a monumental shift away from, basically a new monetary system that if anyone would expect that to be easy, I think they're fooling themselves. So yes, greater volatility is absolutely something we should expect to see. And when that happens, it's better just to shut off your computer, don't look at your phone, go outside and do something, come back a few days later, and you'll see it's right back to where it was. And we've seen that recently. If you go back over the last few months where we see the smash downs, where gold falls by $100 or $200 over a few days, you come back 2 weeks later and it's up higher than it was. That volatility within that range is what keeps everyone, oh, nothing to see there. I'll move on and go back to my risk-on trade like NVIDIA and Bitcoin, where you have the largest retail allocation to equities ever in the history of the stock market. At the same time, we've been seeing on average $2 billion worth of sales by the institutionals every week since beginning of June, and a continual selling since the beginning of the year by the institutionals. So you have the biggest money in the world fleeing, selling into strength that is a byproduct of mom and pa retail all in on equities. Now, what could go wrong there? At the same time, you have the inverse of that in the gold market. The biggest money in the world accumulating, standing for delivery, and repatriating, as the ma and pa is all in stocks and doesn't even know a gold coin when it falls on their feet. So my point is that if you believe that the institutional traders will be wrong on both sides, well, more power to you. it's been my experience that the institutional traders aren't just the wealthiest, they're the most well-informed. And I think that's something people should think about for a moment. Massive participation in equities, not much in the way of commodities for the retail, massive positioning in commodities, including deliveries off the exchange and repatriation by the banks and the central banks, and the lowest continual low allocation to equities and selling huge amounts every single week since the beginning of the year into that environment. What could go wrong? So that's that volatility as well. But the people who are pulling the strings, they know the playbook, and they're moving out, like Warren Buffett, as the public's moving in, and the same exact thing is happening in reverse in the commodity market.
Yeah, two more underscores to what you just said that you've mentioned before, and I think they would fit perfectly with what you just said. That is this record low participation in the equities by the large banks follows a couple quarters of 7-to-1 insider selling by
Yes.
the largest holders, even of the Magnificent Seven, even of those
Yes.
those leading market leading stocks are being divested not only by the CEOs of those companies, but by Warren Buffett and others. On the other side of the coin, you mentioned physical off-taking at record levels from the exchanges. I thought you were going to also say, and countries like China going to inordinate lengths to go around the world and not perturb the price, to buy up on the down low, to obtain their physical through Dore and other semi-processed without disturbing.
But not only that, and that's a huge point, Dunnigan, but not only that, I would add into it, short the price on COMEX, which is the price setting mechanism of the globe, and then buy around the globe instantaneously off of non-price setting avenues, so that you use the paper price the same way the West is. The West has been using it to support the illusion of a strong bond market, a strong currency, and a strong system. It's an illusion. The East has been using it to accumulate. And I think now they realize, well, let's just accelerate that. So we'll suppress the price on paper, and we'll stand for delivery in London. We'll stand for delivery in every non-price setting or price-affected venue that we can. And then we'll go around and buy all the Dore and the concentrate, to your point, at subsidized prices, and completely disintermediate the market. So yes, that's exactly what is happening. And it's happening at the same time as they're shedding treasuries. They're shedding treasuries and using those proceeds in an attempt to accumulate commodities, which are acting in many ways very much like a treasury. They're safer, they're producing greater returns, they're removing counterparty risk. And I think that's really the most important thing, is that now you have to see historic buybacks, bond buybacks by the Treasury, two $10 billion bond buybacks, marking the largest ever. And they're doing that in an attempt. Those are the last 2 weeks in a row, or 2 out of the last 3 weeks in a row. The Treasury comes in and issues short-term debt to have the liquidity to buy back their older maturity debt that's in circulation, to retire that, because there is no demand for it. At the same time, you have the Fed coming in saying it's not QE, spending $50 billion to buy an assortment of 3, 10, and 30-year treasuries, because that demand is waning. These are all very important crumbs that all lead to a bigger picture. And I mean, you can see the dollar is under pressure. The US dollar index fell to a 3-year low recently. And, you know, it's down 10% nearly this year. So it's an environment where why would anyone want to hold treasuries where the dollar is down 10% and gold is up 30 or 40% this year? Same thing last year. Gold was up 40%. The 10-year treasury was up 4%. I'm not sure what the dollar index was for the year. Maybe it was stronger. But if you look really since beginning of 2025, the dollar index has been falling and falling precipitously. In fact, we're right at a level right now where it's got to have been at least a decade plus where it last closed at this level. So we're getting to an area where the support underneath the dollar, you could see it fall much lower. Now that's something Trump wants. But look at it in terms of those holding treasuries. You have a falling dollar, and you have rates that are moving higher. So that's both of those things are kryptonite to bond position already in circulation. And that's why sometimes you have to wonder, are these moves being done intentionally? Again, what I meant by the Biden administration was too stupid to be stupid. This administration, are they doing things in an effort to do something similar to what the previous administration has done to incentivize traders to move away so that we can have that reset, so that we can move to that next stage and point to the folks, the villains who pushed us there? And I'm not saying that's the case, but some of the actions you could argue by the previous or the current administration are silly in a greater context, in the respect that, when you have the world reserve currency, you will always, always, always have a trade imbalance. That's Triffin's dilemma. The need for dollars globally is far greater than they can ever achieve just through trade. And so you have to export dollars. You have to have demand for dollars, which pushes the dollar up, and other currencies down, which makes manufacturing in those countries cheaper. That's why everything went that way to begin with. And so this is really the paradox: is are we better off having the reserve currency or not? Ask Vice President Vance, he'll tell you no. And so maybe, just maybe, that realization is coming into play that, well, we'll do things that will ultimately reshore the strategic manufacturing, which is a necessity. We have to do that, and it won't be pleasant. But do you want to do it and fall on the sword for our own mismanagement and terrible fiscal and monetary policy? Or are they doing these things like tariffs that are actually sanctions masquerading as tariffs, doing things like trying to balance the budget, trying to bring in Doge, who finds $90 billion of waste, but that's 38 hours of spending by the government. That's nothing. And yet we're going to have another $2.5 trillion deficit. It's like the third largest in I don't know how long. So the point of it is that our fiscal irresponsibility under this administration is growing. It's not falling. And so these things that we see, you have to question. And again, I'll go back to what I've said before. If you don't question, and I voted for President Trump, and I thank God he's here. I can only imagine how awful it would be under the Harris regime. But you have to wonder, you have to question everything, because if you don't, you've learned nothing over the last 4 years, where much of what we're learning was a lie. And that's not conspiracy, that's truth. And so, yeah, I wonder sometimes, is this administration continuing this thread of trying to lose ultimately the reserve status because it will make our country stronger, perhaps, after a reset? And that's the piece that people need to keep in mind is, yes, having the reserve currency has been an exorbitant privilege. We've pushed the indebtedness and the interest rate suppression so far that now it's a hindrance. And so you want to bring this stuff back. You want to bring back manufacturing. You want to, you're 60% of the country doesn't have a college degree. So what are we going to do? We need to bring that stuff back. Well, how do you do it? Well, you get into the greatest depression of all time. Well, do you find a villain? And that's the villain. I'm not saying that's what I believe. I'm just saying that a lot of the decisions that are being made seem to point in that direction. But whatever it is, I think that to expect this to be smooth sailing and green shoots moving forward over the next couple of years is insanity. I expect it to be very volatile in all aspects of investing, in all aspects of finance, not just precious metals, and maybe even further into political, geopolitical, societal, spiritual, the whole 9 yards. And at the end of any long-standing system, that's what you can expect to see. And I'd also say one thing. One of the things that you would expect to see towards the end of the dollar is greater use of the dollar, right? And that's what we are seeing. The dollar is being used much more. Why? Because good money they're buying assets, right? You store the good assets. You use the bad money, which is currency. It's like in with the old, that being treasuries and dollars, and in with the gold, in with cryptocurrencies. And that's what you're seeing, a lot of dollar use. But what is that dollar being used for? In my mind, at the highest level, it's being used to de-dollarize. And that's the confusing thing for people who understand. One of the things that I plan on talking about much more is how this works into the dollar milkshake theory, which we are seeing perhaps that starting to fray as well. And we won't talk about that tonight, but soon, that's something that I do want to talk about, because I think this all plays into ultimately where we're heading, and that is to a monetary reset, which I do believe we are in the midst of right now. It's not that bang, it's the slow methodical, where the dollar goes out with a whimper, not a bang. And maybe that's where we're going right now. But yeah, the final chapter has not been written, not even close.
Another point that you touched on just briefly a little while ago was about repatriation of gold. As you're laying out this big dichotomy between the East and the West trying to do all these derivative-based machinations to control and to obscure and to mask the weakness and the frailty of the currency and the system and make it look like it's healthy when it's really toxic. And then meanwhile, accumulation by the non-Western influenced countries. We have a question from Born Hunting. Italy and Germany asked for their gold to be brought back home. Why? And isn't there some more other than those two that did that as well?
Well, Italy and Germany are supposedly the second and third largest holders of gold in the world. And I think when you realize what Germany went through the first time, you're talking almost $250 billion worth combined, German and Italian gold. And why? Because it's a bigger symptom, it's a symptom of a bigger problem, lack of trust. And that's the issue here, is that this is a trust-based system. When it was backed by gold, you didn't have to trust as much as you could redeem it for gold. That was the promise. Always return your dollars at a fixed rate of 35 bucks an ounce if you were a foreign government. Well, at the end of World War II, after Europe had been ravaged by two world wars, it made sense to leave their gold here with the U.S. They would give us their gold, which was a non-interest bearing asset. We would pay them 35 bucks per ounce. They could take that money, invest in our treasuries, earn a yield on it, and always exchange it back for 35 bucks an ounce. That was a good system. The dollar was, in fact, as good as gold, and we had no inflation. And then we saw what happened since 1971. Gold was $35 an ounce at that point. It just touched 3,500 not too long ago. That's 100%. It's lost 99% of its value plus in my lifetime. I was born in 1970. Well, you add into it all of the issues regarding the current political environment, the lack of trust that was brought in, anointed in the seizing of $5 billion in Russian treasuries. It's not our job to be judge, jury, and executioner when you're talking about a global reserve currency and issuer. And the world doesn't trust us anymore, including our allies. G7 members, they don't trust us anymore. And that's exactly what this is all about. And you're right, there's been north of 40 countries that have brought their gold back from both the Bank of England and the New York Fed, which these were the two areas, the two venues that provided liquidity, Western rule of law, safety, and gave direct access to the LBMA and the COMEX, the two fugazi, crooked, manipulated, and starting to show the issues of said manipulation through delivery requests. And I think they're like, yeah, maybe we should get while the getting is good. And we'll see how long it takes for them to return the gold this time. But quite frankly, I think they're late to doing this. And I think you would see more and more countries decide they would want to do the exact same thing. Quite frankly, I think anyone that would leave their gold at either place is silly and missing a bigger picture.
We have a pair of comments here from Michael and Frank Bees. Michael says LBMA already defaulted, and you've said that before, when they began delaying deliveries of physical gold. Frank Bees says, good question. When will the first delivery defaults happen on COMEX, and what will be the impact on the market?
Well, maybe before that happens, they change the rules. I don't know the answer to that question. In essence, the Hunt brothers should have. The environment that the Hunt brothers tried to expose and exploit is exactly what you see right now. Far more contracts than bars backing it. And they bought up all the contracts and stood for delivery. They changed the rules. They being the exchange, which is owned by the banks, which will protect themselves. The difference is the LBMA is not an exchange. It's an over-the-counter exchange. There isn't a central clearing authority. It's peer-to-peer in essence, me versus you. And if it breaks, there's no one there to step in per se, unless they get all of the members to do it. Whereas on COMEX, it's a different thing. It's a different animal. They can just, in essence, create a force majeure, shut it down, say no more deliveries, or do what they did in London when you saw the nickel problem. They just invalidate everything. We're getting to the point where that will happen, where whether it's outright default, it'll appear the exact same thing, and it will be settled in a manner where you would say, well, this was done to avoid a default. And, I think that if we wait for that moment to happen, you can see that they're doing all they can right now to keep that from happening. We get to that point, yeah, if the COMEX were to default, the entire precious metals complex breaks down. And I think that ultimately where you will see things change is you're beginning to see the development and the maturity of other exchanges in Dubai, in Shanghai. You'll see the BRICS development of the BRICS Metals Exchange. You'll see the Moscow Exchange. These exchanges now in Singapore, these exchanges that are coming up throughout Asia in particular, and the BRICS network, will be more of a cash and carry reflective of real price settlement. And it's almost like these players are trying to exploit as much as they can through delivery using the Western system until the Western system breaks. And whether it breaks by outright delivery default on one of the two exchanges is debatable. But I think, in essence, whether we get to that point and see it or just realize it was inevitable before they came in and stepped in to protect themselves and changed the rules, the way they did under the Hunt brothers, where they said you can be as short as you want, but only long a certain amount, like 1 million contracts or whatever it is. And then anything over that amount, they were forced to sell. And that's what drove the price down. Now that is manipulation of the exchange to protect itself and screwed the Hunt brothers. Well, something like that I would expect would happen before you'd see one of these big banks blow up. But in London, no, I think in London you could see a default by a very large institution, and there will be no one in there to step in to rescue. It's a fair question. I can't really answer it definitively, but simply to say it seems like we're getting closer and closer to that moment.
In a moment, I'm going to give you a chance to run down through the specials before. Well, we should do it now. We got a couple more questions here to get to, but I'm going to share that real quickly for you. Hold on. You should see that share now. If you can read those out loud.
1 ounce silver kangaroos at $2.99 over spot. Those are the purest silver coins in the world at $4.9 fine, along with the Maple Leafs. They're the only coins that come in mini mint boxes of 250. My 17-year-old daughter would have no problem carrying that, and a lot easier to move around than the 500-ounce boxes. So yeah, love those a lot, really do. They're beautiful coins. 1/10-ounce gold maples, $45 over melt. Again, from a standpoint of trading and barter, they're as good as it gets. 24 karat pure gold. I think it's always great to maximize your utility and versatility if you can, if you're not paying a huge price. And this indeed is a very good price for a very versatile and very well-respected coin. 1 ounce platinum. Platinum is breaking out, and I have a renewed bullishness for platinum, which is much like silver, been held down for a very long time. At 119 over spot for the 1 ounce platinum. Platypus from the Perth Mint, another amazing coin. The U.S. Mint, to my knowledge, has not made a platinum eagle in a couple of years, and they're not making one this year, and I don't think they are lined up to make one next year. The model of inefficiency, that being the U.S. Mint, the choices for getting 1 ounce platinum are further and fewer between. I like these a lot.
And last but
And
not
my favorite, at 99 cents over spot, the constitutional silver, dimes and quarters, the best value in silver. And I don't know, I've been saying this for a while, and I was blown away by how much that we actually have in stock. A lot, north of $11 million worth in stock. People who want the finest value in silver, it's right here.
And we can swap silver bars and rounds for these if people want to get into U.S. Mint lineage at a very modest premium differential, or at zero premium difference if you take a small percentage hit in ounces. So either way, you can get out of bars and get into U.S. Mint lineage silver if you want to.
Yeah.
Stopping that share, and God, I don't know that we have time for these others. They're so good. We'll do this fast. Joe Potter said, the FHA, excuse me, yeah, FHA Chair Bill Pulte said he had ordered Fannie Mae and Freddie Mac to prepare a proposal to include cryptocurrencies as assets in the risk assessment of single-family mortgage loan. And Caleb Munholan said, I saw that, and Trump says we're going to be the digital asset kings of the world. God help us.
Yeah, well, I mean, and what they're basically saying is that if you have a crypto account, once it's converted into dollars, that they'll allow you to use it. In other words, it's a step into acknowledging the crypto is legit. Yet they don't do that with gold. I mean, it's just absolutely silly, and it's a desperate attempt by, I believe, by a country who is showing very little demand for U.S. Treasuries, and it's the stablecoin market that is really standing behind Treasury demand that is filling the void for the central banks that are shedding it. So the biggest money in the world is accumulating gold and assets and commodities instead of treasuries. The void had to be filled somehow, and it's through stable coins that back the crypto market. So how do you move between crypto and currency? You're using stable coins, you're issuing demand for treasuries. It doesn't surprise me. They're not saying you can use crypto to buy property, but they're saying you can look at your Coinbase account, and if it's proven that that money came from that Coinbase account, that they will allow you to use it as equity to purchase your home.
And boy, we're getting a lot of additional good questions. We're not going to have time to on the stream, but there's one here that's fairly general in nature. I think you can hit this one. Josh Ellis asks, is there a diversity balance recommendation Andy suggests for precious metals, gold to silver, as they recommend in stocks to bond, like 60-40?
Right now, it should be higher silver allocation than gold. Ultimately, it should be higher gold than silver. But this is one of those rare moments in time where the value you're getting in silver is just too hard to ignore. And throughout most of history, gold or silver would have, at least over the last 100 years, you're talking, would be valued at anywhere from 1/50th of an ounce to 1/80th of an ounce. But it's coming out of the ground right now at a ratio of 1 ounce of gold to 7 ounces of silver. And so, 1/7. And so, but it's priced at 1/100th. And so you're way outside of normal valuations, historical valuations. It's one of those opportunities that don't come around very often. So while I do believe ultimately the place to be is gold because it is being reintroduced into the monetary system, I think the value you find in silver is second to none. And this would be the time to take a calculated speculation and be heavier in silver with the intention of trading it to gold when that ratio normalizes, and history says it will. This is an anomaly in every sense of the word.
And we've got a good question here. We'll just have to touch on it briefly. That is, Mary Chapman says, few people ever address what investors could do as the dollar declines and silver and gold go parabolic. Andy, what do you think of this?
Use your dollar to buy things that are increasing in value. Sell your weakening asset and put it into appreciating assets, and save assets that are appreciating. In other words, if you save your money, if your wealth is denominated in dollars, you're destined to go broke. And I think you move it into assets that are appreciating. That's the whole idea. That would be the thing to do. That's why you're seeing uses of dollars increase as people are using that money to buy assets that will do well in an environment where the dollar starts or continues to lose value globally through money creation, through de-dollarization. This is a trend that's in motion, a trend that won't stop, and at some point will accelerate. So buy assets. Assets feed people, liabilities eat people, and dollars ultimately are a liability.
We are pretty much out of time, but I wanted to share two comments from viewers that go together here. You're going to love this. Fazdal says, Andy looks like a news anchor. I'm expecting him to have a TV screen behind him with graphics. And Latro Genuile says, he doesn't look like a news anchor because he's telling the truth, LOL.
Thank you very much, you all. I appreciate it. And stand by for within the next day, maybe even tonight. I don't know when it's going to hit. Some very interesting developments and news coming out of this office, and we're excited. We're excited for what's coming, and I figure if we're going to be spending as much time as we are trying to tell people what's going on, we might as well look the part too. So I appreciate the kind words very much.
Well, we're grateful for your presence here, whether you're wearing a tie or a suit coat or a Pink Floyd T-shirt.
And no dogs barking this time, as I
Well,
promised.
we miss your cute little muffin there. But anyway, everyone else, thank you for being here on the live chat. Make sure you share this widely. We need to get the word out there because most people are not hearing this stuff from their financial planners or the mainstream media. You guys know that. Andy, thank you as always for being here with us every week
Easy
on the
for you
Weekly
to
Market
say. The
Update.
pleasure is mine, my man. Thank you.
Take care, everyone.
You too.